All right, let's jump right into this. If you're running a business, you already know that having the exact right equipment is absolutely make or break for your operations. But actually going out and buying that equipment outright, well, that can be a massive drain on your working capital. Welcome to This Explainer. Today, our goal is to completely demystify the world of equipment leasing. We're going to cut right through all that dense financial jargon to help you make informed, cost-effective decisions that will actually drive your business forward. So, here's our roadmap for today. We'll start with the leasing dilemma, break down the $1 buyout lease, explore fair market value leases, look at a few alternative options, navigate the tricky world of tax and accounting, and finally, strategize your lease endgame. Section 1. The Equipment Leasing Dilemma, Choosing the Right Financial Path. Think about this for a second. Research actually shows that at any given time, a whopping 61% of businesses are wrestling with cash flow issues. That is a huge number. And it sets up exactly why leasing is such a powerful tool. When cash is tight, draining your vital reserves to pay cash for expensive machinery or taking on those really restrictive traditional bank loans that demand heavy collateral is honestly a huge gamble. Leasing just offers a much safer, way more manageable route to get the tools you need right now. And that brings us to the core dilemma you face, a literal crossroads decision. On the one hand, you have ownership, right? The desire to build long-term equity and hold on to those valuable assets. But on the other hand, you have flexibility, the need to frequently upgrade your tech and preserve your daily cash flow. You really have to stop and ask yourself, do we want to own or do we want to upgrade? Every single lease structure we're going to cover today branches off from that one fundamental question. Section 2. The $1 buyout lease, the path to ownership. Okay, let's cut through the jargon right away. A $1 buyout is what's known as a capital lease. Even though it's got the word lease in the name, it actually functions way more like a traditional loan. The leasing company basically finances the total cost of the equipment, and all those finance charges just get rolled right into your fixed monthly payments. You get all the perks of ownership throughout the entire term, and at the end, officially transferring the title costs you a nominal fee. Literally just a single dollar. Heavy machinery is literally the perfect match for this $1 buyout path. Why? Because assets with a really long shelf life, think excavators, agricultural tractors, or specialized manufacturing lathes, they retain their value for years. If you know a piece of equipment is going to be the beating heart of your operations for the next decade, you absolutely want to be building equity in it. But you've got to be careful because misaligning your lease and your asset can be a disaster. Let's look at Maria, a restaurant owner. When she opened her catering business, she chose a flexibility-focused lease for her commercial refrigeration and cooking equipment just to keep her initial monthly payments low. But here's the catch. Commercial kitchen gear is a long-life asset. So at the end of her 5-year term, she got hit with a completely unexpected $22,000 buyout just to keep the ovens her business literally relied on. She mistakenly chose flexibility over ownership, and it cost her big time. The takeaway here, we have to know exactly when utilizing flexibility is the smart play. Section 3. Fair market value leases, the path to flexibility. So an FMV lease is considered an operating lease. Let's anchor that dense accounting term to its real-world impact. This is essentially just a rental agreement. The absolutely crucial point here is that the lessor, the financing company, retains all the risk of that equipment depreciating. Because they take on that risk, your monthly payments are typically way lower than they'd be with a $1 buyout. And the best part? At the end of the term, you have the total freedom to just walk away, return the equipment, and upgrade to the newest model. Let's look at James, a video producer, to see why this rocks. James's business runs entirely on high-end cameras and editing workstations. And in his industry, tech becomes totally obsolete in, 3 to 5 years? By using an F&B lease, James keeps his monthly costs super low, and when his tech starts aging out, he isn't stuck holding the bag on depreciated assets. He simply returns the old computers and signs a fresh lease for the latest generation. For a guy like James, that ability to constantly upgrade is a total game changer. Section 4. Alternative leasing options, finding the middle ground. When you map out the whole lease family tree, the dividing lines become super clear. The capital options, the ones geared toward ownership, like the $1 buyout, diverge completely from the operating options, like the fair market value lease. But within these two main branches, there is actually a lot of room for customization. Comparing these side by side, the $1 buyout hits you with the highest monthly payment, while the fair market value gives you the lowest. But check out that fixed percentage lease. It offers a brilliant middle ground structure. Your monthly payments sit comfortably right in the middle, and you lock in the final purchase price up front, say 10 or 15% of the original cost. You basically share the depreciation risk with the lessor, and you get absolute cost predictability. And there are even more of these powerful niche strategies out there. Early buyout options, or EBOs, let you snag the asset before the lease even ends. If you have an FMV lease and realize, hey, this equipment is holding its value way better than expected, an EBO lets you buy it out early to avoid a crazy high market appraisal down the road. Then you have seasonal leases. These are incredible for businesses like ski resorts or landscapers because you match your payments strictly to the months your cash is actually flowing. Finally, the sale leaseback. If you're cash poor but equipment rich, you can sell the equipment you already own to a leasing company, instantly inject that cash into your working capital, and just lease the equipment back. Your operations literally never miss a beat. Section 5. Tax benefits and accounting. Navigating the balance sheet. Now, for our US-based viewers, one of the absolutely most powerful tools available to you is IRS Section 179. When you use a capital lease, like that $1 buyout, the IRS treats you as the official owner right from day one. Section 179 allows you to deduct the entire purchase amount of qualifying equipment from your gross income in the very first year. Depending on your tax bracket, that essentially acts as a massive immediate discount on the overall cost of your equipment. But, and this is a big but, you do have to balance those tax perks with the cold hard accounting realities under rules like ASC 84. A $1 buyout appears directly on your balance sheet as a liability, which can definitely impact your debt ratios and how much you can borrow in the future. An FMV lease, on the other hand, is usually kept off the balance sheet entirely, with the monthly payments just written off as standard operating expenses. Oh, and a quick sidebar for our Canadian viewers, beware of the CRA's tax recapture rules. If you exercise a buyout option for cheap and then turn around and immediately sell that asset for a high fair market value, that profit isn't treated as a simple capital gain. The CRA converts it into a recapture of depreciation, which means a much, much higher tax hit for you. Section 6. Navigating lease end, the end game. Okay, we need to define one last crucial piece of jargon, the bargain purchase option. This is a clause hidden in some contracts that allows you to purchase the asset for substantially less than its expected fair market value when the lease terminates. Why does this matter to you? Because if this clause is in there, accounting standards immediately classify your agreement as a finance lease, right out of the gate, simply because it's reasonably certain you're going to take that amazing deal. Ownership is practically guaranteed. So how do you handle those final, critical days of your contract? Well, let me walk you through 3 highly actionable steps to make sure you don't lose any money. Step 1. Know your exact buyout option today, so you can budget the exact cash you'll need months in advance. Step 2. Ensure you actually get credited for any first or last advanced security payments you made on day 1. Seriously, leasing companies will not always remind you about this credit. And Step 3. Stop what you're doing and mark the exact buyout due date on your calendar right now. Which leads me to this massive warning. Avoid automatic month-to-month renewals at all costs. This is the ultimate hidden financial trap of the leasing world. If you forget your buyout date and fail to notify your lessor, which is usually required 60 to 90 days before the lease even ends, your contract is just going to automatically roll over into a wildly expensive month-to-month rental. You will literally be bleeding cash, paying extra for equipment you could have already owned outright. Well, we have covered a tremendous amount of ground in this explainer today. So the absolute most crucial point I want to leave you with is this provocative question. Which path is actually going to drive your business forward? Is it the stability and equity of long-term ownership, or the sharp competitive edge of flexible upgrading? Match the exact right lease structure to the exact right asset, and you put yourself completely in control of your company's growth. Thank you so much for hanging out with me today, and keep learning.